Sophisticated models and risk management are influenced by the collective pulse. Algorithms add to this effect by enforcing program behavior, stop-loss triggers, trend-following systems, automated hedging, all of which act like invisible arms amplifying the initial motion. What emerges is a market that seems to have a life of its own, reacting first and asking questions later. And yet, there is a method hidden in the apparent madness. If you look closely, patterns emerge. Markets tend to overreact in the short term and correct over time. The initial chaos often contains valuable information: what traders fear, what they expect, and where the liquidity is concentrated. Savvy investors and policymakers study these reactions not for their immediate truth, but for the signals beneath them. The first movement is rarely the final answer, but it's a glimpse into the collective psyche of the market. Understanding this can give you an edge, but only if you're patient and disciplined enough to separate the noise from the signal. The mathematics behind it is simple, brutal, and uncomfortable. Markets are essentially networks of coupled agents, each with imperfect information. A small change in input can lead to large, nonlinear outcomes, a principle mathematicians call sensitive dependence on initial conditions, or chaos theory. Combine that with leverage, margin, and automated execution, and a tiny rumor can cascade into a market-wide movement worth billions. This isn't exaggeration, it's a structural reality of modern finance. The market doesn't pause for understanding because pausing is dangerous. In the high-speed ecosystem, hesitation costs money, influence, and sometimes survival. Contrast this with the media narrative. News outlets report, analysts opine, pundits debate. By the time the story is coherent, the market has moved on. Headlines simplify, stories rationalize, and humans assign blame or meaning. But the market doesn't care about narrative. It reacts to flow, to probabilities, to collective anticipation. That gap between hype and reality creates both risk and opportunity. For those who can navigate it, early reactions reveal hidden tensions in the system. For those who chase them blindly, it can be devastating. Zooming out, the implications are enormous. Global markets are increasingly interconnected. A reaction in Tokyo can ripple to London and New York in seconds. A rumor in one sector can trigger a credit freeze elsewhere. Policymakers, investors, even ordinary savers are exposed to this invisible speed. Understanding that markets react before understanding isn't just a curiosity. It's central to risk management, economic planning, and personal finance. It also raises philosophical questions. If the market often moves ahead of comprehension, who is really in control? And if perception drives reality, how stable is a system built on anticipation rather than certainty? And here's the kicker. No one can fully predict these reactions, not even the most sophisticated AI or the most experienced trader. The first reaction is inherently uncertain, irrational, and sometimes absurd. It's a humbling reminder that even in the era of high-speed data, the human desire for certainty clashes with the chaotic logic of the system. Markets will continue to react first, ask questions later, and surprise everyone in between. That's the uncomfortable truth we live with, and it's why watching, studying, and understanding reactions matters more than ever. So next time you see a sudden market swing, pause before judging it. The headlines might be wrong. The experts might be confused. The market itself is moving ahead of comprehension, and in those first moments, the invisible machinery of finance is speaking, louder than any news story. The real question isn't why the market moved. It's what that movement is trying to tell us, and whether we're listening closely enough to understand before the next wave hits. If you want, I can also create a precise time-stamped pacing guide for the script, so it hits exactly 22 minutes, showing where to add pauses, emphasis, or subtle visual/graphical cues to maximize viewer retention. This would make it production ready. Do you want me to do that next?